Good evening, everyone. My name is Kristen Ray. I'm the co-founder of Vital Investment Partners, and I would like to thank you for joining our webinar this evening. So tonight we will be discussing multifamily fundamentals, investing in multifamily real estate. This presentation was designed to answer some of the most commonly asked questions we receive regarding multifamily real estate investing, particularly using the syndication model. Some of the things we will review include defining multifamily real estate, investing in single family versus multifamily real estate, pros and cons of multifamily investing, why should you expand your portfolio beyond stocks and bonds, trends in multifamily, and how you can invest passively in multifamily. No managing tenants, no flipping, no hassle, no toilets, none of that. We will also review the multifamily investing process, and we'll have a Q&A session at the end. So if you can think of any questions during a presentation, please feel free to put them into the text box and we will address them at the end of the presentation. So let's jump right into it. What is multifamily real estate? For the purposes of this presentation, the term multifamily means 5 or more units. Multifamily reaches true economy of scale at 150 units and can support a full-time staff. 1 to 4 units are treated as residential and qualify for residential loans. Here are a few reasons why we favor multifamily real estate. In multifamily, you have more tenants to cover expenses when someone moves out. It's much more scalable. When you have 5 or more units, they are not valued as residential, thus giving you the opportunity to add value via your business plan execution. Multifamily real estate does well in economic downturns. More units in one location makes it much easier to manage. Whereas with single family real estate, if a tenant moves out, you could have 100% vacancy. It's either someone's there or they're not. It's not scalable. The value is based on other properties in the area, comparables. It does not fare well in the economic downturn, as evidenced by the 2008 crash. In addition, single-family properties may be in multiple locations, making managing a lot more challenging. Some of the benefits of investing in multifamily real estate include cash flow. Cash flow is defined as the amount of profit left once all expenses have been paid. Multifamily real estate is a great way to build and maintain a steady stream of cash flow. Even when there's a vacancy or even a few vacancies, oftentimes the property will have enough income coming from the rents and other fees to cover the expenses. And normally it's just still cash flow. Tax benefits. We all are looking for additional ways to decrease our tax burden. Taxes are the working class single highest expense. With that being said, multifamily real estate comes with a plethora of tax benefits to include being able to reduce your taxable income if you still have a W-2 job, in addition to things known as accelerated depreciation and bonus depreciation. We'll get into some of those terms in a later segment. In addition, we love that multifamily real estate is a hard asset, it's tangible. It's not an intangible object or piece of paper as a stock or bond could be. Historically, it has outperformed the stock market, particularly when you look at your return adjusted risk and adjusted for inflation. Multifamily real estate does well in an economic downturn. When we experienced the 2008 crash, multifamily real estate barely budged. In fact, you may oftentimes see an increase in demand because unfortunately people are losing their homes, but they still don't want to be homeless. They still need a place to stay. We love the business model of multifamily real estate. By that I mean you have the ability to come in with a plan to change the property for the better and increase your bottom line significantly. It's a great retirement vehicle. During your retirement, you can build a steady stream of income in addition to any other retirement plans or arrangements that you've made. You can generate additional cash flow, which can help to cover some of those unexpected expenses. Multifamily real estate is an excellent way to build generational wealth. Because it's a hard asset and it's tangible, it's something you can pass down to later generations. Multifamily properties are less volatile than single family properties. By that I mean, values of multifamily properties do not decline sharply in a recession because the properties are based on income. If the property is still producing income, it has no reason to decline in its value. In fact, during a recession, you, as stated before, you may even see an increase in your occupancy because those people still need a place to live, and they come to multifamily. They come to apartments when they can't live in their homes any longer. Also, rents fluctuate less rapidly than home prices. When you look at the trends, you may see home prices sharply increase or decrease. Rents tend to steadily go up over time. Now, nothing is without some potential downside, including multifamily. So one of the downsides is that it is illiquid. Real estate as an asset class in general is not something that's very liquid. Once you're in, you're in. With multifamily, most deals are held anywhere between 2 and 10 years with an average of a 5-year hold. You don't necessarily have direct control over how the asset performs. Therefore, you have to build trust in your sponsors, understand their business plan and their ability to execute. If you have any 1031 benefits, those can be more challenging to use in a multifamily syndication versus a single family property. Now we can discuss how a multifamily property is valued. Multifamily properties are based on net operating income. They are valued based on this formula. They're valued like a business, not based on a comparable like residential. So simply put, the NOI is the income minus the expenses. Okay, let's walk through an example. So you have a 200 unit apartment complex and you raise rents by $25 per unit. The value of the property goes up by $857,000 per year. So you say, Kristen, how is that? How is that so? So we have 200 units multiplied by $25 per month per unit increase in rent by times 12 months. So 200 times 25 times 12. Multifamily properties are also valued based on a cap rate. We'll get into the details of that in a later segment, but for now, a cap rate is simply another way to value multifamily properties. As of this recording, the average national cap rate in the United States is a 6, but let's call this one a 7. Let's say you got it for a better deal. It's a cap rate of 7, which would yield $857,000. 200 times 25 times 12 divided by 0.07% is your $857,000 increase in value. How are multifamily properties evaluated? Loans are based on the property's income and occupancy, not your personal credit. The lender is looking at the income potential of the property and the syndicator's ability to execute their business plan, stabilize the property, and get it profitable. Lenders on these properties have very strict guidelines, very, very strict, much more strict guidelines than they do in single family. This helps to protect the investors. The banks want to be sure before they issue a multi-million-dollar loan that the individuals who are going to be responsible for this property are competent and able to perform. They are not in the business of losing money. Now, expanding your portfolio beyond stocks and bonds. So, one of the things that I often say to people is America's Social Security system was designed for a different era. When Social Security was invented, they were not thinking that people would live as long as they had. The model was designed so you could work until you were 65, live just a few years beyond that, and pass on. So they wouldn't have to pay you out these large sums of money. With that being said, let's take a look back. Historically, back in the 1900s, the average life expectancy was about 49 years old. Fast forward to 1960, at the time Social Security was rolled out, the average life expectancy was 69. So they figured, oh, okay, well, they can collect Social Security at 65. They'll live another 4, maybe 5 years if they're lucky. And, that's it. But we have far exceeded their expectations. As of this recording, the average life expectancy today is 79 years old and is increasing. For women, the average life expectancy is 81. Another thing that is noteworthy and why you would consider expanding your portfolio beyond stocks and bonds is because healthcare costs is rising faster than inflation. So when you get in your older years, having that passive cash flow and additional streams of income can help to supplement what Medicare or whatever other insurance you don't have may not pick up. So here's a chart. This chart demonstrates how quickly the cost of healthcare is outpacing inflation. So since the early 1960s, the cost of living has gone up by 168%, which, if you think back to what a car or a dozen of eggs or anything or gas cost back then in comparison to now, it's astounding. So take that same thought and think of it in terms of healthcare costs. Since the early 1960s, healthcare costs have gone up by 818%, far outpacing inflation. Another thing that is to note is that the majority of these increased healthcare costs come or start coming around the last 10 years of your working days, meaning as your capacity to work decreases, your cost of healthcare continues to go up. Stock market return adjusted for inflation are too low for you to get ahead. What is the actual annual growth over the past 17 years when you adjust for inflation? So everyone likes to talk about the stock market. So let's talk about it. Here's an example for you. If you put $1 into the stock market on January 1st, 2001, and you withdrew that dollar on December 31st, 2017, adjusted for inflation, your dollar has not doubled in value in 17 years. So I would imagine that it would be pretty difficult to get ahead with inflation and everything else with simply um, investing in the stock market and just trying to save. You will be far, far in the red. What can you do to get ahead? So, understanding compound returns and add investments to your portfolio with potentially higher yields. Higher yields do come with higher risk. However, the math below will show the astonishing difference. Let's walk through an example. Let's say you invest $100 for 30 years at 3 different levels of returns. Let's see what you end up with. After 30 years, your $100 at 2% would have grown to $182. At a 10% return over 30 years, $1,984. At 18%, $21,217. This is why investments with a slightly higher risk are worth considering. When you look at the difference in the returns, if you were to plot this, this would be known as an exponential growth curve. All my math people understand this would not trend in a straight line. This would be an exponential growth curve where you would see this 18% will clearly outperform these other two forms of investing. So let's look at this from another angle. Let's look at this with the end goal in mind. Let's say, for example, you have an end goal of acquiring $15,000 per month in passive cash flow when you retire in 20 years. If you said, okay, I'm going to save for my retirement, how much would you need to save each month to meet that goal? Keep it in mind. In 20 years from now, when you consider inflation, that 15,000 is more like 6,000. Okay. At a 2% investment level, you would need to save $30,530 per month. Now, perhaps that's very reasonable for you. And if it is, congratulations. After this webinar, please let's discuss, because I would also like to know how, I could potentially save that much money per month. Moving on to a 10% investment level, you would need to save $2,370 per month. At an 18% investment level, you would need $433 per month in savings to reach that goal. Another question we often get is, how long is an investment? If you do a syndication, how long will my funds be tied up? And the answer to that truly is it depends. On average, 2 to 7 years is the time frame for a syndication investment. This is not a fix and flip, so investors should be prepared to invest for that time. The average time frame is 5 years, and I've even seen some that go as long as 10. This is my favorite part. We're going to talk about trends in multifamily. So there was something put out by the National Association of Realtors, the mouthpiece of Buy a House. The National Association of Realtors stated, rent is the new buy. Americans prefer to rent. There has been a paradigm shift in the way people, particularly the millennials, view home ownership. They don't view it quite as favorably as past generations. So there was a study by Adfolio and the Wall Street Journal that stated only half of current renters plan to become homeowners in the next 5 years. Now, that's quite a few people. I mean, we're talking upwards of 5 million. Are we building 5 million new multifamily properties to account for this? Not even close, not even half. This will continue to drive the demand for multifamily housing. With that in mind, this study stated that 31% of renters cannot afford a mortgage. 43% do not want to own a home. Millennials prefer to rent. They like to be mobile. They like experiences. They like to move every few years. With the increase in technology and employment in the technology sector, a lot of people are able to work from home, which means that they are able to move every few years and experience different aspects of life without being tied down to a mortgage. 39% of people enjoy renting. They don't want to bother with the maintenance or the commitment that purchasing a property comes with. Millennials are not buying homes as in previous generations. So this is a chart that pretty much depicts what I previously discussed. So if you take a look at the chart, in 2005, well before the last recession, the home ownership started to decline, as represented in the yellow line. Home ownership has been dropping since then and flattened out in 2008. This is great news for investors. The millennials are represented in the blue line. And after 2008, the millennial home owner population just fell off of a cliff. They are just not at all interested in purchasing homes. And it hasn't picked back up. Baby boomers are downsizing to apartments. 75 million baby boomers are out and about. They're looking to downsize once their children leave. They are ready to have fun. They're active, older adults full of life. They are not sitting at home in their rocking chair. This population is turning to apartments because they enjoy the conveniences and the amenities. They don't have to deal with the maintenance. They don't have to deal with a lot of sets of stairs if they don't want. They are being called echo boomers. And they like to move closer to their kids and where they can have amenities and conveniences. They are not looking to sit at home in a rocking chair. So with all of that being said, how can you benefit from all of this? Well, first stop is teamwork. Teamwork allows us to come together and purchase large multifamily properties. This is the process called syndication. Syndications are processed through the Government Securities and Exchange Commission, otherwise known as the SEC. These are the syndication police, if you will. This is used to protect investors. The SEC looks over what the syndicators are doing to make sure that they are in compliance with the federal laws. The investment process. Many of you have inquired about the investment process. How does this work? In summary, syndicators find a multifamily asset to purchase and offer the opportunity to their investors who may choose to participate in the acquisition. Investors may invest as themselves. You can invest through a business entity, a family trust, an IRA account, a QRP account, and receive a portion of the equity share, cash flow. I should add in their tax benefits and any other upside. The syndicators build a team, identify the asset, place the asset under contract, perform due diligence, raise capital, and manage the property. For these efforts, they receive a portion of the funds, management fee, and cash flow. Investors do not have to bother with the day-to-day operations. No tenants, no toilets, no management, no headaches. Cash flow is typically distributed quarterly, although that could vary based on the business plan. Thank you. So in summary, that was the fundamentals of investing in a real estate syndication. I appreciate everyone's time. Thank you for joining us on this webinar. We will certainly have more to come. Right, and I'm going to address some of your questions here. Okay, so the first question, can I use my IRA to invest? Yes, you can. We would approximate about 25% of the investors we work with have used their IRA to invest. Yes, you can. I'm not a tax professional. Please consult your tax professional before doing so, but I do know that that is possible. What is the minimum investment amount? Well, that depends on the deal. Typically, I've seen as low as $25,000 and as high as $250,000. The average investment amount is $50,000, but that could vary based on the deal. Which markets are you looking at? Great question. For starters, we only look at emerging markets. We look at markets that have strong population and job growth. People want to work and earn wages to take care of their families, and we know that's not going anywhere. With that being said, the markets that we look at could vary based on the demographics and any changes in those demographics. So right now we are looking at Charlotte, North Carolina, Jacksonville, Florida, Orlando, Florida, Columbus, Ohio, Las Vegas, Nevada, Phoenix, Arizona, Dallas, Texas, Houston, Texas, Tampa, Florida, Huntsville, Alabama, to name a few. How do we keep track of our returns? Another great question. One of the team members who will be hired to assist with the deal is a certified public accountant. So the accountant will keep track of your returns and will issue a K-1 that has additional details on your returns. Once we invest, who do we talk to if we have questions? Okay, so myself, Kristen Ray, or Brian Ray, we are able to answer any questions you have. Feel free to reach out to us, call, text, email, or you can go on the website and schedule a call, and we will be more than happy to answer any of your questions. In addition to that, I send out a quarterly statement that talks about the property and the progress of the property. All right, these other questions look personal in nature, so I will end the webinar here. Thank you for your time. These questions I will answer on an individual basis because they are very specific to those individuals. And if you have any questions, please feel free to reach out to us. Thank you so much for attending our webinar. We will have more forthcoming. And happy investing.